Let's address what the FII flows are suggesting. In fact, we have with us Seth Freeman joining in right now to talk about what he's making of fund flows as of now. Seth, hi, good morning. Great to have you today on ET Now. Let's first address India,
Thank
right?
you.
And we've been seeing consistent buying for the last 14 sessions. In fact, quantum almost half of the last time, FIIs poured in money into India equities. Just wanted to understand what you think is working in India's favor right now as opposed to the rest of the world.
Well, I appreciated some of the comments earlier about somewhat of a disconnect that India has recently achieved. But it reminds me of problems going back to the 2000s when there was tremendous discrepancy between FII flows and domestic investment. And one of the things that happens is it creates a lot of volatility because you can have the market jarred by just as rapid outflows as inflows. Now, with SIPs and so forth over the last decade and a half, it's become much more stabilized. But it is concerning to me. India is getting a lot of positive press globally. There was also serious political problems, at least from a U.S. expansion standpoint, into China. And so I think India is a recipient of that.
Seth, morning. Given the fact that, yes, indeed, the FIIs have remained on a buying spree, but there are going to be a lot of factors as well down the line. You've got the monsoon, the elections, etc. Do you believe that this will largely influence the liquidity flow, or do you believe that it will continue to remain consistent buying?
No, I think you're going to see some consistent buying. I don't think that investors are really focused so much on these near-term domestic concerns because, in general, Indian companies are growing more rapidly than U.S. companies. And we're looking at a, recession. We're definitely looking into a recession here. How severe it's going to be is another story. But, there's still, major allocations to emerging markets. The one thing that happens, though, is as U.S. rates rise, the dollar becomes stronger, and emerging markets currencies, including India, can suffer because of that, and so that is a risk for foreign investors.
The other concern also is more near-term, right, Seth? I mean, the June 1st deadline for the debt ceiling, and I guess that also is going to impact flows out of the US and perhaps to other EM economies like India.
That's a little more optimistic than I think. Maybe flows out of treasuries and ironically into banks temporarily, but I don't know that money's going to really shift into India as a hedge against a prospective U.S. default. And I personally believe that's a very low risk situation, that we've seen this brinkmanship between the political parties here. It seems like almost every time we need to raise the debt ceiling. And I think once the rhetoric and the finger pointing and everything else starts to fade away, we have to have a deal here. It would be an absolute shock if the debt ceiling's not raised.
And what's the expectation in terms of valuation-wise as well, how India is looking currently? And have you seen some sort of a shift from the other emerging markets pouring into India now?
Well, again, the economies that have been dependent on consumption from China, those are gonna suffer. The overall real estate economy globally is suffering from just higher interest rates, and so I do think I've been on the same mantra for nearly 20 years now about the long-term prospects of India, and so much has happened, and there's still so much room to go.
Now, I want want to switch back, Seth, to what the Fed action is. And now you have a critique even in Elon Musk, right? This morning he's saying that his biggest concern is that Federal Reserve has been acting upon stale data. They were behind the curve in raising interest rates, and they're going to be slow at decreasing them as well. Just wanted to understand, with all the talk about recession, which, like you said, seems inevitable, what is really, you think, the Fed Reserve action going to be like?
Just as a fundamental issue, I tend not to agree too much with anything Elon Musk says. He's a very successful car manufacturer, but maybe he should stick with that. I don't know about his economic and Fed prediction and economic policy statements. But clearly, we had a long period of very low interest rates, and this has affected especially the U.S. Housing market. The low interest rates allowed house prices to inflate incredibly. And now that we have mortgage rates that have gone from basically 3.2 or 3.5% to 6.5% and 7%, that radically changes the real estate market. The Fed is going to be slow in reducing rates. We have a strange problem in that they are trying to slow the economy. They're also looking at employment figures, and we happen to have, increased interest rates, but we also have a relatively high level of employment. So it seems a little crazy from a policy standpoint to create an environment that is intended to increase unemployment or has an effect of increasing unemployment in order to mellow out the economy and mellow out inflation. So it's definitely going to be a challenge.
All right, good to have you on board, Seth, putting all of those data points into perspective. Definitely, getting a take from you as to what you make of those comments coming in from Elon Musk, as well as, of course, the liquidity situation back home. Time for a very quick break. Be right back.